Good evening. You are watching the Economic Reality Check. Tonight the headline is this: the global economy looks strong on the surface, but underneath the system is getting more stretched. Stock markets are still rising. Employment data still looks solid. But inflation, debt, and energy prices are quietly pushing the economy toward a turning point. That is why some analysts are calling this moment the Great Reset of 2026. Let us look at the bigger picture. The latest data show that the U.S. consumer is still holding up. Even with high fuel prices, retail sales have risen for 3 straight months. That is feeding the idea that the U.S. economy is still grinding along. But this is not a risk-free rally. Energy-driven import costs are climbing. Inflation remains a key concern for policymakers. That means the risk is hidden inside the data, not on the surface. Now, let us look at the U.S. setup. The U.S. equity rally has pushed the S&P 500 through the 7,500 level for the first time. This is powered by strong AI, related sentiment, and surprisingly resilient consumer spending. The Federal Reserve is caught in a tricky position. On one side, the economy still looks strong. That justifies higher rates for longer. On the other side, inflation risks are still elevated, so the central bank cannot rush to cut too quickly. That means the cost of money stays high for longer. Homeowners refinancing or resetting their mortgages, young people paying off student loans, small businesses borrowing to expand. All of these groups are feeling the squeeze. At the same time, AI-related names, chip makers, and big cap tech keep leading the rally. This creates a dangerous illusion that the whole economy is in a safe, permanent uptrend. It is not. Let us zoom in on the debt side of the story. When interest rates stay high, debt shifts from a tool into a time bomb. In many markets, we are already seeing signs of stress. Credit card balances are creeping up, auto loan delinquencies are rising. Household budgets are stretched by energy and housing costs. Yet stock markets keep climbing. That convinces investors that everything is fine. This is exactly the kind of environment where the risk is not a single crash. It is a slow, grinding pressure. If inflation stays stubborn and borrowing costs do not come down, a small shock could ignite a wave of defaults, a fresh spike in energy prices, a geopolitical flare-up. Any of these could trigger forced selling, then margin calls, then a self-reinforcing sell-off. In short, the current setup looks strong only as long as people keep paying. The higher the debt and leverage, the thinner the margin for error. Now let us turn to China and Asia. The Chinese economy is still in a narrow lane. It is trying to keep industrial activity and exports alive, while avoiding a deeper property market collapse. The property sector remains weak. Households are still under pressure from falling prices and tighter credit. When property stops working as a piggy bank, consumers tend to spend less. That drags down the entire growth engine. So the big question for 2026 is this: can China engineer a soft landing, supporting exports and tech without sparking a full-blown property crash? If it fails, the shock will not stay inside China. It will spill into global trade, energy demand, and commodity markets. That is why this moment is not just a China story. It is a global risk story. Now let us look at the global backdrop. Beneath the record-level stock indices, the global growth picture is fragile. The IMF has already downgraded its growth outlook. It is warning that the world economy could tip into a mild recession. This would happen if energy prices and geopolitical tensions keep rising. One of the most worrying signals is the shifting pattern in investor flows. In Korea, analysts point out that big cap semiconductors are starting to show signs of overheating. Samsung Electronics, SK Hynix. These names have surged for months. At the same time, money is beginning to rotate into alternative growth themes, especially robotics. Stocks like LG Electronics and Doosan Robotics have recently spiked. Investors are searching for the next AI story. This rotation is not yet a full-scale sector shift, but it is a warning sign. The market is starting to look for the next place to park excess liquidity. When that happens, it often means the current leaders are already stretched. The risk of a correction rises. That is why the next phase of the cycle may not be another clean bull run. It could be a period of choppy, high-volatility growth. Here is tonight's warning. The global economy may look strong on screen, but it is not as safe as it appears. High asset prices, high household debt, stubborn inflation. These are all mixing with geopolitical uncertainty and energy price volatility. The result is a system that can tolerate shocks less easily than most investors assume. That is why tonight's viewer call to action is this. First, review your leverage. If you are using heavy margin or credit to chase rallies, consider reducing that exposure. Do not let your portfolio depend on a single theme, even if it is AI or semiconductors. Second, diversify your exposure. Spread your capital across different regions and sectors. Third, keep meaningful cash on hand. Economic shocks tend to come when everyone least expects them. Having dry powder lets you buy when others are forced to sell. Stay informed. Stay cautious. And we will see you again tomorrow with the next economic reality check.